Welcome back. The South African property sector has made a rebound following a hard knock from the global pandemic, higher interest rates and load shedding. The sector is now poised for further growth amid trade and economic uncertainties. Independent property analyst Keillen Ndlovu joins us now for further insights. Keillen, thanks so much for your time today. And let's start there. The property sector really being in recovery mode for quite some time. How much of a spanner in the works does the current macroeconomic conditions throw to the sector and its growth prospects, considering that we are in a very uncertain period?
Thank you, darling. It's interesting times. The market has been volatile, as we've seen over the last week to 2 weeks. If you look at the sector, fortunately, it's quite diversified across different sectors, from retail, office, industrial, not only in South Africa, as well globally. So offshore markets, they make up about 50+% of the sector. So if the rand is weakening as well, the investors also benefit from that. But it's tough times to predict returns in the short term.
Yeah.
So you have to ride through the volatility and see how this plays out.
And let's look at some of the factors that initially boosted returns and growth within the property sector. We saw, post the global pandemic, when some calm started returning into markets, we had that pent-up demand helping. We've also seen, the reduction of load shedding coming into play as well. And some of those rate cuts also boosting sentiment in that sector. Do you think there is further upside to come, even with, the global dynamics at play? Because when you look at, I guess, the fundamentals here at home, things do seem good. Yes, we do have some jitters playing out on the political side, but overall, things look good.
Yeah, so things are turning positive. If we look at, we're coming off a very low base. And earnings outlook, we're looking at 3 to 4% positive growth compared to last year, which was negative 3 to 4%. So it's all marginal, with the interest rate cuts potentially, as well as reduction in load shedding. So lots of savings in terms of money spent on diesel and maintenance, and employees returning to offices. I was coming here as well, it boosts the retail sector, not just offices, where employees go for lunch, and McDonald's and KFC busy outside. So those are all small incremental things are helping the sector. And the sector has reduced its debt levels from about 44% beginning of last year down to about 39%.
And that brings me to my next question. Talk to me about, some of the shifts we are seeing within the property sector, particularly when it comes to the type of properties that these REITs own and these listed property counters own. Are we seeing maybe perhaps a shift within the office sector? Because yes, there is a return to the office, but we are seeing, smaller office spaces coming into play. We're also seeing smaller malls, your local shopping center, getting more footfall than the bigger malls. What kind of shifts are we seeing when it comes to landlords and the shifts within their portfolios when it comes to disposals and acquisitions?
So let's start our office market. We've seen most of the landlords selling office properties, particularly the B to C grade portfolios. But if you look at your A and P grade, they're doing well with vacancies in the single-digit levels. And what's helping the sector as well has been some of the assets being sold to private players who are buying those office portfolios and convert them to residential student accommodation as well. That's one trend we've seen in the office market. But it will take time to recover, and it depends on the region. If you look at Western Cape, doing quite well, with Gauteng still struggling, relatively speaking. So that's the office market. The retail sector, so the bigger malls depends which areas, but what we've seen, the trend has changed to where you're seeing strength in the neighborhood and community shopping centers around where people live. And one sector that's continued to be quite positive has been the non-metropolitan retail. That's the township and rural retail, helped by also social grants and government support.
And what about, the industrial, logistic, buildings? I know there's just been super growth with the growth of e-commerce.
Yes, continues to do well. We looked at the numbers for the direct property returns. It was the best performing asset class within the direct property market with over 15% total returns. So as you mentioned, it's all to do with logistics, e-commerce.
Yeah.
It's not manufacturing anymore, and also have low vacancies, and there's limited supply coming through into that market.
Interesting plays there. And then before I let you go, Keillen, which counters are seeming, you know, a bit more attractive than others when you are looking at those listed property players?
So it depends which sector you're looking at. In the offshore markets, Vugile, for example, we've just come back from Spain and Portugal. They're doing quite well there, as well as Lighthouse. So the exposure to Iberia, which is Spain and Portugal, where the economies are growing and there's limited supply, and we're seeing a further growth coming into those markets. So we like that region of the market, as well as Central and Eastern Europe. There's one counter that's mass real estate, looking quite cheap, but they have to solve their DJV or disagreements with the development partner. We're waiting for that. And then locally, we like counters with exposure to township and rural retail, so like Fairvest as well. Vugile is in that space, and Resilient.
Keillen, thanks so much for your time and insights.
You're welcome.
That was independent property analyst Keillen Ndlovu.